Disney shares surging nearly 14% today to an all-time high. So tonight we want to answer the simple question: should you buy into this magical move? We're going to lay it all out for you. First, the news that sent the stock up and away. Then a technical take on today's beastly move. We kick it off with the news. Disney telling investors it expects between 230 and 260 million Disney Plus subscribers within the next 3 years. That is on top of the nearly 87 million Disney Plus subscribers it currently has. By comparison, Netflix has just over 195 million subs worldwide. So those are the fundamentals. Let's get to the technicals now. Carter Worth is with us. Chartmaster, you heard that music. So we ask you, after today's record run, is it time for investors to let it go?
Sure. So, before we look at the charts, it's really all about who you are in the market and what your time frame is. There have been plenty of instances where Disney has gapped up like this. Today, up 13.5%. Its Q1 beat in 2019 was about a 12% move. On vaccine day, November 9th, we know it jumped about 12. But what we do know is after big jumps like that, it's pretty sideways, fallow on a week-over-week basis. But let's look at some charts. The first is the breakout. It's a conventional kind of thing. Everyone agrees, is well recognized, that a stock that moves above a well-defined range with a gap, and you can see it there, is the definition of a breakout. Now, second chart, look where the stock stopped. It stopped to the penny at the internal trend line, in effect, for the past year and a half. I mean, literally stopped on that line. In fact, it peaked essentially around 11 o'clock, and it spent the rest of the day going sideways. So it was aggressively re-rated, but didn't really progress. Now, two more charts. Where are we in relation to the 150-day moving average? You could use the 200, you could use the 50, but if you were to look at this chart, Disney is trading some 39% above its 150-day. Now, take a look at the next chart. This is going back for the past 10 plus years, and you can see here again the relationship of price with average price over 150 days. So, in the history of the stock, going back to the 1970s, it has only traded farther above the 150-day moving average one other time. And in principle, that gets the time frames. Long term, this is hugely bullish. Tactically, I think you fade the move, you take profits.
All right, so Carter says let it go. We'll see in a bit, Carter, on options action. So you got the fundamental story, you got the technical take from the chart master. How would you trade Disney here? Brian Kelly, what do you say?
So I think I'm with Carter on this one. I really like his take on this because if you think about it, this is a long-term fundamental play here. Because not only are they going to have more movie streaming online, but what we know about Disney is that they have tremendous leverage in their platform, right? So they can go to the parks. The parks are going to reopen. Their cruise ships are going to reopen. They're going to be able to take what they do on Disney Plus and bring it to all of those places. But that does take a bit of time, and you've priced in this surprise here. And so where it's trading now, and remember, this stock was 78.5 or so back in March and April. So it has had a tremendous run this year. It is priced in an awful lot of good news. And so for me, I think you get a better entry on this. It doesn't mean that I don't like Disney. In fact, I think it's going to be one of the better ones coming out of the pandemic. But I think you get a better entry. I would wait either for today's gap to be filled or for the low of today to serve as your support, and then wait for that breakout again.
So you like it long term, but you think that there could be a pullback shorter term. James McDonald, I think part of the betting here is that this is a premium product that people will pay for. In fact, they announced a price hike of $1 in the United States, up 29% in Europe. And a bet on the management team. CEO Bob Chapek may be new to the role. He's not new to Disney, and he's still got Executive Chairman Bob Iger around in terms of this execution, which is a dramatic change in how the business is structured and how the business considers and executes content.
Well, Bob Iger remembers the old days when you had a lot of customers and you had a big brand and you had a lot of action. And there was a firm back then called AOL that got everybody's attention, and the stock ran up on potential. And we saw where that happened. And I love Carter's technical analysis, and BK's always spot on with his fundamental outlook. But my grandmother told me, use common sense. You know, right now the PE ratio is at 87. There's more forward-looking upside for this than Netflix, which masters this game. Netflix announced similar subscriber growth from the boom from COVID, and look what happened. That sub growth then cooled off for the next 3 months, and this COVID level growth rate is not feasible for the long term with Disney. Netflix shows that more content equals more subscribers, and that's a good thing, but we're shifting attention away from the other weaknesses with this company. This is not a tech company. The media only makes up 40% of the total revenue. Parks and products make up 23%, and they're going to take massive hits here with the new lockdowns over the holiday seasons. Let's use our common sense. International segments, 23.5% of their total revenue. It's going to be suffering, and there's no Fed overseas to save them. So let's use our common sense and stay away from Disney here, up at $175. No way, no way, no way. We can't worry about the long term. We've got to survive this recession that's coming. No to Disney.
I would never argue with James McDonald's grandmother or anybody else's grandmother for that matter. But Steve Grasso, we got to put a footnote here or an asterisk next to James's commentary, and that is he is an even bigger bear than Brian Kelly ever was, with a full-on bear suit zipped up to the very top. So you got to take that advice in terms of staying away from Disney with a grain of salt. Where do you stand, Steve?
So first of all, we got to give kudos to Dan Loeb. He spotted this, or at least he was the one that really shined a light on Disney back in October, saying that they should cut back on their $3 billion investment in dividend and put it towards content, put it towards streaming. So Disney was the king of content. Now the question is, as you posed it, are they going to be the king of streaming? I agree with Carter. I agree with the other gentleman. This stock, if you go for just on a basic retracement level, Melissa, this stock could come back into the 50% retracement from this near-term move, and that's $148. If you bought it today, you're going to be disappointed. But this is a bunch of things rolled up into one. This is my 3-day rule. Never buy it on an outsized move like this. Wait for it to hold for 3 days, number one. Number two, when you look at, to James's point, I think they're actually going to expand that multiple, and that was Dan Loeb's thesis, that all you have to do is close the gap. You don't need a Netflix multiple. You just need to expand that multiple. So I think it's not going to kill Netflix. It will take a profit share, or market share, I should say, from Apple. I own this streaming service. I own Netflix, and I own the Apple streaming service. That's what most people are going to do. This is a strategic story change. Mm-hmm. Wait a couple of days, but I still think you're okay to buy this around that 150 level longer term. So
you guys are pretty much in full agreement in terms of what to do with the stock. Now, the question is, how does this news change the landscape of streaming? We just heard this week from a conference. We heard from AT&T CEO about HBO Max. They added about 4 million new users in less than 3 months. Peacock, which is a streaming service of Comcast, which is the parent company of CNBC, said at the very same conference that it added 26 million users since the end of October. A little bit different because that's an ad-supported model. But Disney announcing that it's going to spend up to $14 to $16 billion eventually on content, BK. I mean, this is like an arms race. Is this going to force others to up their content spend? And what does that do to how you look at whether those stocks are the plays?
So there's a couple ways to kind of play this, right? Generally speaking, I don't like to invest in something that's going to have kind of this competitive war. But we're at the really early stage of this. I think Disney has the competitive advantage in that they can leverage it with their parks, and they can leverage it throughout their entire ecosystem. That being said, there is a ton of money being thrown at content. So if you want to be a contrarian and you made a ton of money on Disney, good for you, buying it at 78 or 80, and you sell it here, I say you buy LA real estate, because it seems like the people who are making the content are going to be making a ton of money.
That's certainly a sort of a third derivative play. James McDonald, how do you think this shakes things up?
I think that the nature of these spikes in users and subscribers and revenue, they're fickle. When something better, something new, something interesting comes out content-wise, it's so easy to go to your phone and hit cancel and go to your phone and hit subscribe. These are not sticky customers. These are not sticky revenues. This is a fickle space. This is a tech space that's got so much upside potential for so many players. Yes, Disney's the content king. Yes, Disney's a great business, but this is not something that they can quickly defend when someone else comes out, and I just don't like the downside with this. I think that the digital marketplace is just evolving. There are still artificial intelligence technologies coming out to push individual product preferences to devices, and there's just so many ways that this market can go. I don't like the subscriber spike story, and we saw that, like I said, with Netflix, right? COVID drove everybody to Netflix, and then when the stock went up, as soon as that abates, the stock comes back down. And so for an investor, it's a risky bet here at this price, at this level. I think there's just too much competition coming.
What is so amazing, though, Steve, is that this stock has doubled since March. So this stock has benefited almost purely from this notion that it will be a streaming powerhouse, and nothing practically from the notion that this is a reopening trade, which we have yet to see take effect on Disney. So with that said, I mean, don't you feel like maybe there is still another boost to come once the reopening trade sort of catches fire?
Absolutely. In Disney parks, it's a $16.5 billion revenue generator. This is something where if you had the option on it never reopening, you're losing money right now. That's decaying. We're going to reopen, and the vaccine is gaining steam. So if the parks reopen, they're going to wind up spending, Melissa, you mentioned the number, 14 to 16 billion by 2024 on content. They're just trying to replace this 16.5 billion in revenue that they're receiving from the parks. The parks are going to do that for itself. I'm not going to go to a park anytime soon, but once the vaccine comes out, there are loyal people who are up and down those parks every year. And I think that number is going to come back on in large force. Remember, there's a lot of people that are dying to get out of the house, dying to do something. And Disney and those parks, they're going to close that 16.5 revenue gap that they've had in the parks very quickly.
Yep.
Shepard Smith here. Thanks for watching CNBC on YouTube.